All right, welcome to this explainer. Today we are tearing open the mystery box of that three-digit number that secretly dictates your financial life. You know, it follows you around making huge decisions behind closed doors. Now, most people treat it like some kind of dark magic, but today we're treating it like a code to be cracked. We've got a lot to cover to keep things moving fast, so let's jump right in.
So, in the US, your credit score usually sits somewhere on a scale between 300 and 850. And this number isn't just pulled out of thin air. It's generated by highly specific math models. Think FICO or VantageScore. And lenders, they're pulling these scores from three major bureaus: Equifax, Experian, and TransUnion.
But look, rather than just geeking out over the math, we need to ask an immediate, high-stakes question. What is this number quietly costing you every single day? I really want you to think about that because this is absolutely not just about getting a shiny new piece of plastic in your wallet.
Your score reaches way beyond credit cards. Landlords are using it to decide if you even get that apartment. Utility companies check it to demand hefty deposits before they'll even turn on your lights. In many states, insurance providers use it to set your premiums. And get this, some employers even use a version of this exact number to evaluate you during the hiring process. Crazy, right?
Okay, on to Section 1, the real dollar impact, high stakes. Let's look at the brutal reality of what a poor score actually costs you.
Just notice the massive gap in total interest paid on a standard mortgage here. For the exact same house and the exact same loan amount, the difference between an excellent score and a poor one isn't just some rounding error. It is literally tens of thousands of dollars straight out of your pocket.
And the exact same leverage applies to auto loans and credit cards. A poor score immediately triggers punishingly high interest rates. A good score isn't about bragging rights at a dinner party. It is quite literally one of the highest leverage financial habits that costs you absolutely zero to build, but will cost you an absolute fortune if you ignore it.
All right, Section 2, the 5-part formula. Let's go ahead and reverse engineer the rules of the game.
Like we said, your score is not magic. It's just a specific pie chart made up of 5 distinct factors, and they are weighted entirely differently. If you understand these 5 slices, you control the score. So, let's break them down.
The absolute largest piece of the pie is your payment history. Simply put, did you pay on time every single time? Just one missed payment can cause more damage than almost anything else we'll discuss today. And notice how it's tiered. Being 30, 60, or 90 days late triggers separate, increasingly severe alarm bells for lenders.
Next up is credit utilization. This is just how much of your available credit limit you're actively using. Commonly, you want to keep this under 30%. But if you want the absolute strongest impact on your score, educators suggest keeping it under 10%. Maxing out your limits literally screams high risk to the algorithm.
Now here is the crucial trap that trips so many people up. This ratio is based on your statement balance, not your current balance today. Meaning high balances on the day your statement generates will instantly spike your risk profile, even if you pay the whole thing off 3 days later. Timing is everything here, guys.
The remaining smaller factors involved are the length of your credit history, which, simply takes time, avoiding too many new hard inquiries from applying for a bunch of things all at once, and having a responsible mix of credit types, like maybe a card and a small installment loan.
Moving fast here. Section 3, rapid fire, mistakes and myths. Let's bust some widespread best practices rapid fire style.
First up, checking your own score. The old myth says it hurts your credit. The reality? Checking your own score is what's called a soft inquiry and absolutely does not hurt your credit. Honestly, you can check it every single day if you want to. Applying for new credit is a hard inquiry, and only that causes a temporary dip. Next massive mistake, avoiding credit entirely because you've heard all debt is bad. Irony alert on this one. Having zero credit history creates what lenders call a thin file, making you incredibly hard to approve for anything at all. You are essentially locking yourself out of basic financial tools.
Do you think carrying a balance and paying a little bit of interest helps your score? Think again. That is a complete myth. It provides literally zero credit benefit and only loses you money. Pay it in full every single month, no exceptions.
And hey, never close your oldest paid-off credit card just to tidy up your wallet. Actually, scratch that. Don't close any old free cards, because by doing that, you'll instantly shrink your average credit age and simultaneously spike your utilization ratio by wiping out that available limit. Just put the card in a drawer, buy a coffee with it twice a year, but keep the account open.
Section 4, building your credit fast. Here's your actionable strategy to go from 0 to 850. Step 1 is getting a secured card. This is where your own cash deposit acts as your limit, which makes it incredibly easy to get approved. Step 2, utilize a credit builder loan, where money is locked away while you make reported payments. Or, Step 3, you can become an authorized user on a trusted family member's older, well-managed account to safely and legally borrow their good history. Once you finally have an account open, pay close attention to this, because it's the absolute highest leverage 5-minute setup in personal finance. Toggle on autopay for at least the minimum balance. This acts as a permanent safety net to protect your payment history slice of the pie from just a simple, silly memory lapse.
So, let's bring the whole shebang together into the winning strategy. Pay on time every single time. Keep that utilization incredibly low. Let your oldest accounts age gracefully. Check your free reports regularly, and if you see an error, legally file a dispute directly with the bureaus. Then, just step back and let time and consistency do the heavy lifting for you.
As we close out this explainer, I want to leave you with a crucial thought to consider tonight. Really look at your own financial habits. What exact story is your very next statement balance going to tell the credit bureaus? Are you building a foundation for wealth, or are you paying the poor credit tax? The formula isn't a secret anymore. The next move is entirely yours.